Hello everyone, hope you're doing well and having some profits. Today I decided to put this model for free. This model can be your one model for life as it has a high win rate and a good risk to reward. So bear with me today, I'll teach you when and how to trade the flip model, which is nothing but the first sequence of the Fénix setup. So if you know what is the Fénix setup and have watched my previous video, you know that this is the Fénix setup, right? And the model that I want to teach you today is nothing but this one, from this point to this point. So you see everything is correlated and everything will make sense once you connect every dot. So grab your notes and listen carefully. I named this model the flip model, and it's simply waiting for change in the structure on the 1 minute, 5 minute, any time frame you want, because price is fractal, and you only wait for these conditions to happen and you execute according to what I will teach you. There is two conditions for the model to happen and the measure that you need to take for you to take the trade. All right. For example, we have a valid SNDR responsible for breaking a structure, which we call the valid SNDR. So this needs to break the structure and gets violated after its mitigation. I will show you an example here. For example, we have this high, right? Then we have this, then we have this, and we take the structure. And this is the SNDR responsible for taking the structure. So at mitigation, we violated, and we violate maybe also this low. All right, so you want to take this in here as your flip zone, and you wait for price to come mitigate this, and you take the trade, and your target should be either the low that mitigated the flip, all right, and or if we have any inefficiency below and non-structural swing below that low. So you want to keep some of your contracts and your position for these inefficiencies or non-structural swing. So this will be your trade a little bit above the high of this SNDR, and you want to target the low that mitigated the flip, or keep some of your profits. I can guarantee for this model a risk to reward of 1 to 2. That is at least that you can have with this model. For the second condition and the second setup is the last valid swing that delivered the last high or low and gets violated after its mitigation. So for example, if we have a downtrend like this, all right, and then we have this. So this is the last swing that put a new low, and then we didn't mitigate it, we just violated that zone, right? So you wanna put this as your flip zone and you wait for price to mitigate at least at the 50% and you take the trade. If there is any inefficiency above, like an imbalance, a VG, liquidity void, or non-structural swings, you want to also target those levels, right? And targeting only the high will give you at least 1 to 2, right? But sometimes you'll see that we will just wick and make things like this, an accumulation here, and that we go up. So in this situation, I won't take the trade to target this. I will look for inefficiencies, non-structural swings above or non mitigated zones, and I will target that. In this case, your risk to reward should be at least 1 to 3. 1 to 3, especially when you have this case and you have a small zone in here. So getting at the 50%, putting your stop loss in here, it's a small risk in here, right? And what you can have compared to this is really big. This is why I'm saying that this model will at least give a 1 to 2 or 1 to 3 and above. The important part of this model to be a success, you need a valid SNDR, meaning that SNDR should be valid, and I'm speaking about this. So it should have a valid swing high and valid swing low. Alright, so this is very important. And for the valid swing that delivered the last valid low or valid high, for example, this swing like this, this also should be a valid swing low and valid swing high. Alright, this to be successful, you need to have a valid SNDR or a valid swing that delivered the last valid low or valid high. So now it's time to see some examples on the charts. Let's take this example about the valid SNDR. So here we have low, a high, and then we have this, and then we breach it, the SNDR. The SND responsible for taking this low. Alright, and when we came to mitigate the SNDR, you see what happened? We breached that level. So we take this high and this low of the SNDR, and you see that we wicked through and came in. So this is your entry here. What do we have? We have this high, and this high, and this inefficiencies, and everything in here on the 5-minute will look like non-structural swing. So this will be your target, and this is how you will trade it. Your stop is a little bit below the low of this SNDR, and you target at least this level in here. So in this situation, we have a 1 to 2.3 risk to reward, right? second example in here, we have this high and we have this low, then we have this SNDR responsible for taking this high. Alright, so when price comes to mitigate this SNDR, you look that we breached the SNDR. So what you would do here, you take a short from here and you target at least the low that mitigated the flip, the SNDR, alright? Or when you see that we have inefficiencies, equal lows in here, you see that we have this non-structural swing in here. So this will be your target. In this situation, we have a valid swing high that delivered this valid low. Then at its mitigation, you see that what happened, we took the high, right? And it doesn't matter if we wick it through or close it above, especially when we still have some inefficiency or non-structural swing up, side, and above this zone in here. So in this situation, you take this measure, you go long after tapping it's 50% and your stop are a little bit below. The price needs to tap its 50% after breaching the high or the low of that flip zone. In this case, it happened at this wick. So this is your entry and you're targeting at least this level in here or a little bit above at least at 30% of this zone, and you got yourself a good 1 to 2, for example, quickly and without any stress. In this example, we have this valid low and this valid high that constitute a valid swing high that delivered the last valid low, and then we started trading against the zone in here, right? So you see that we took the high, and then now what you do, you want to trade at least at the 50% and target any high above the high that mitigated the flip. All right, so in this case you can enter here, or since you have seen that we came in the range and left the range, so we want to take below the 50%, all right, for example in here, and target this high and above if we have any inefficiency or non-structural swing, like for example here, and there's still an inefficiency in here, so we want to target this. And in this example you have 1 to 2.6. In this example we have this in here that delivered this high, then got breached, and we took the low of that swing. So now we want to take this and measure it. Your entry is here, all right, and you want to target at least the low that mitigated the flip in here after breaching the zone, all right. And if there is any inefficiency below, you want to target that also. For example, this in here, this imbalance, so you want to keep some contracts off for this one. That's all about the flip model. Hope you enjoyed the video. What I want you to do now is to go backtest this and see it happening on the charts. Get well used to it. No need to thank me, just put a little bit of work and you will see the results by your own eyes.